Hello, I'm Taylor Jimenez, and I'm doing my financial analysis presentation on Netflix. So, a little background about Netflix. It was founded in 1997. It started out mailing physical DVDs and games, and that was their main focus. In 2011, streaming really became their primary focus because of changes in technology. So they changed their entire business model. Now Netflix is one of the most successful streaming platforms on the market, but you can still subscribe to their DVD plan, actually. Their vision statement is becoming the best global entertainment distribution service, and their mission statement is we want to entertain the world. Netflix, as you know, is huge. They currently are available in 246 countries and territories. Only 4 countries do not allow Netflix to do business. That's China, Syria, North Korea, and Crimea. Let's see. So they are projecting to reach 251 million subscribers this year. That is about 110 million more users in just 10 years. They had 41 million users in 2013. So that is a pretty big jump. And then they have 12,800 full-time employees as of the end of 2022. So looking at the 8 pillars of Netflix, their PE ratio is 34, which is not good. Ideally, it would be below 20. Their profit margin is 14.21%, which is pretty good. We want it to be above 10%. Their revenue for their 5-year year-over-year is increasing, so that's good. Their profit for the year-over-year change of the last 5 years is increasing overall, but last year it did actually go down for the first time. But overall, it's still increasing pretty regularly. The number of shares outstanding in the last 5 years is increasing, which is not good. It is just increasing slightly, so not much at all, but still it is increasing. Their current assets is more than their current liability, so that is good. Their free cash flow growth is increasing, that's also good. And then their market cap comparison for the 5-year average free cash flow is not good at all based on the last 5 years, so I'll look at that next. They have a lot of negative numbers there involved. So let's see, the average 5-year cash flow ended up being a negative number, 516 million. And so using the 15 as the growth multiplier, because it is still growing, but obviously they haven't had some amazing years, so I went kind of in the middle there. Um, Regardless of what the number is, it ends up being negative because of their negative 5-year average. So I guess that would technically mean that you should never buy Netflix at that rate. So I went off of a 3-year calculation instead, and that would mean that it would be worth buying at $2.54, which I don't really think that is necessarily realistic either, but at least these numbers for the last several years is what it comes out to be. They spent a lot of money on content assets in the last couple of years, and they've spent a lot of money making their own original content, so that's why they're still trying to catch up, I guess, since the lockdown in 2020. So after going through the different information in the financial statements, I didn't find anything too crazy or research worthy. They did get a favorable opinion from the auditor, so that's good. One thing that I thought was interesting in the critical audit matter is they have to amortize their streaming content, which it makes sense. It's just not something that I would have really thought about. They use their historical viewing data to estimate the amortization schedule, and then they look at the real numbers and adjust it at the end of the year. So the auditors claim that this is a complex and subjective process because it's solely based on estimations and things can change a lot throughout the years. Another thing that I thought was interesting is that they had so many possible risks listed. There was, I think, over 12 pages that were just dedicated to possible risks and the way that they would manage them. So I thought that was pretty thorough that they included everything. And I mean, it was things that I wouldn't even have thought of, things that seemed like they probably weren't very likely, but I guess because they are possible, they included them and they had a risk management plan in place in case it were to happen. So they were at least prepared. After looking them up in the news, Yahoo Finance had a little bit of information about their future goals, and they are now offering a lower price plan without ads in hopes to bring more subscribers that maybe couldn't afford their higher prices before. They're hoping to end 2023 with a $3 billion free cash flow. That would be about double what it was last year. As of January, the CEO, Reed Hastings, stepped down and he will just serve as the chairman of the company. This has been a new strategy to, quote, maintain its position in a tough market. Now we'll look at the competitors. I wanted to compare Netflix with Hulu and Amazon Prime Video, but Hulu was bought out by Disney and they include all of their financial statements together. And then the same thing with Amazon Prime, they include all of their Amazon things together, so it might be a little misleading, but these are the numbers that we ended up with. Netflix stock price is $329, Disney's is $99, and Amazon is $106. So they're not too crazy different, but Netflix is about 3 times more than the others. Netflix's PE ratio is 34, Disney is 57, Amazon is 396. That is a lot higher. They get higher and higher than what we would want, which would be below 20. Um, Netflix's current assets are $9,266,000,000. Their total current liabilities are $7,931,000,000. So their current assets still are more than their liabilities. For Disney, their current assets are $29,098,000,000 and their current liabilities are $29,073,000,000, which is just almost the same as their current assets, which is not that great. It looks like they could pay for all their liabilities if they needed to, but it would be cutting it close. For Amazon, their total current assets are 146,791,000,000, and their total current liabilities are 155,393,000,000, which is actually more than their total current assets, which is not good, which is how we got the current ratio. Netflix's current ratio is a little bit above a 1. Disney is just barely more than a 1. And then Amazon is 0.94, meaning that their total current liabilities exceed their assets. Here we have the common size income statement for the end of year 2022. Netflix and Amazon's end of year is December. Disney's was October, so I still just use those numbers for the end of the year for them. The cost of goods sold, Netflix is 60% compared to the revenue. Disney is 65% and Amazon is 56%, so they're very similar there. Gross profit, Disney has 39% gross profit Compared to revenue, Disney has 34%, Amazon has 43%. Again, very similar here. Netflix is right in the middle. It was also right in the middle for cost of goods sold. For operating expenses, Netflix is 21.55%, Disney is 25.98%, Amazon is 41.42%. This time, Netflix is actually on the lower end, and Amazon is quite a bit higher than the other two. For net income, 14.21% net income compared to revenue. Disney has 3.8% and Amazon has 0.53%. So it looks like Netflix is ahead there on the net income. In comparing the future goals of the three companies, in 2020, Disney reorganized its media entertainment division to focus on streaming and push their direct-to-consumer strategy. This seems to be their main focus still at the end, as of the end of 2022. The CEO plans to implement some structural changes that he claims puts decision making back in the hands of Disney's creative teams. This seems very similar to Netflix right now. They moved away from DVDs a while ago. They're focusing on more direct-to-consumer streaming. And then Amazon, fairly similar. They're hoping to become a strong alternative to other streaming platforms. Similar to Netflix, they are producing a lot more original content. They're spending more and more money to produce their own content. In conclusion, based on the free cash flow and growth multiplier, even though the numbers were in negative based on the 5-year average, with the 3-year average, it looks like I should buy about $2.54. I still don't think that that's very realistic for the future years. Realistically, for me, I might buy if it was decreased by at least 25%, to be about $250 a share. Netflix is still a growing company and doing pretty well compared to its competitors. Um, so I think it's doing good, but with the way technology is growing and changing exponentially, you just never know what the options might be available 5 to 10 years from now.